Let's connect the global dots with Andrew Ferris, independent market analyst who joins us live from Hong Kong. Andrew, good morning and thank you for joining us. I guess there are two big trends or two big global trends. One, the weakness in the dollar index, and B, a collapse or a crushing fall in US tech stocks.
Well, actually, I will tend to look at two completely different trends. I have to disagree with you. Trend number one is, of course, that the three major central banks, that is the Fed, the European Central Bank, and the Japanese Central Bank, are moving in totally different directions. The Fed is mildly expanding, but with a contractional bias. Japanese is flat out, more than ever. And the European Central Bank, it's not quite making up its mind, given, however, that it still reduces liquidity. So the three major central banks are going in completely different directions. No wonder the markets are surprised. And that explains partially, of course, why the US dollar continues to stay weak, to the extent that the markets somehow still buy the other economic tale. They are much less concerned about the stability of the European Union. And if anything, the tightness in the liquidity helps to explain why the euro, goodness me, it's incredibly strong. It just refuses to weaken. And that, of course, explains why there is an ambivalent reaction to the US dollar. I mean, we're in the middle of a very, very peculiar set of circumstances. And as far as the tech stocks are concerned, I consider this to be much more a sectoral issue rather than a macroeconomic issue. Yes, you buy shares companies that effectively are selling ideas and not things. And that's always a little bit difficult to actually price, particularly some of these companies, especially the media companies. They still got very ambivalent sets of numbers as far as earnings is concerned and where they're going to make their money next. So that's my main concerns right now.
Andrew, what's the sense that you're getting about China? Because, there is a whole lot of spook in the markets about the slowdown. The PMI has shrunk now for a fourth month consecutively. What's the sense that you're getting?
Well, isn't it funny, actually, the PMIs, both the PMIs, the official one, which has got a much broader coverage than the HSBC one that has got a much narrower coverage, were up in March compared to April. But I didn't hear any major sounds about this because they were up by about 0.1%. Not a great deal, but effectively stabilizing. The concerns about China tend to be exaggerated to the extent of an expectation of somehow of a major internal financial crisis. And I will never tire to point out that to have an internal financial crisis, you need a banking sector which is hugely exposed to the property sector, and the Chinese is much more contained, much more narrowly exposed. You need to have a big fiscal deficit which is funded from outside, and China doesn't have a big fiscal deficit, and all of it is funded from the inside. And also you have to be a huge net external borrower. China is a huge net external lender. Actually, the Chinese will try very hard to have a domestic financial crisis. I hate to say, I don't think they will. But that the economy is slowing down, yeah, it has, but marginally from 7.7 to 7.4. What is of concern is, of course, is that despite all these, let's say, ambivalent results, the stock market is continuing to be one of the worst performers in Asia, about 7% year-to-date down, which doesn't help, of course, with a relatively tight monetary policy, which is progressively being loosened up with the loosening up on the appreciation of the renminbi, and also, of course, with some mild unloosening of the reserves for regional small banks. It's a messy picture, but not a picture that would warrant an alarm. So yes, I look at the Chinese figures and to know I'm not seriously concerned, except, of course, I don't like the fact that my clients are not making money in the Chinese equity market. But that's no news. That has been the case for nearly the last 5 years. One of the consistently worst performing markets with one of the consistently best economy in terms of GDP growth anywhere else. Show me another economy which is growing at 7.5%. I don't see any. Not in Asia, in any case.
Well, the Shanghai Composite, in fact, is trading at its 2008 low. That just tells you that how disconnected are markets when it comes to the core economic growth. So, Andrew, what could be the next big market-moving event for global markets? Back home for India, it's elections. But for global markets, what is the next big thing which we need to monitor?
Can I just take one moment in India, because this is very close to my heart. The Sensex is now amongst the 3 best performing indexes in Asia. I'll say that very slowly. 9% year to date in US dollar terms. The other 3, guess what? they completely ignored stunning markets. Indonesia, 20% year to date. Thailand, about 10% year to date. And Philippines, around the 10% mark. So if I was investing in the three little ones, including India, I will be making anything between 10 to 20% year to date, read my lips, US dollar terms. Very good. In India, however, we have to get the elections out of the way. And what does concern me is the recent uptick on both CPI and WPI inflation, and the fact that the yield curve is flat to inverted. That shows a tight, not loose monetary policy. However, the rupee has been doing quite well, flat at 60. Great news. Okay, no great moves. But I don't see any time soon a loosening up in the monetary policy, so that taken in conjunction with a good, meaning a kind of a clear Modi win in the elections, might boost the stock market. So I'm happy with what I've seen, but I will tell clients, go ahead and pile up on Indian equities in view of the fact that we are likely to get a good election result. I will be a little bit cautious for the time being, given that monetary policy continues to be tight and inflation is not down and out just yet.
So sectorally, Andrew, then, in light of your cautious approach towards India, what would be your view? Would you put your money on domestic cyclicals, consumption-related stories when it comes to India? Or would you, put in money into safer bets, which are sort of dollar-denominated, the likes of IT or Indian pharmaceutical companies?
I will stay clear out of pharmas, because there is huge upheavals going on in the global pharma business. And of course, to some extent, this will always impact the generic part of the pharmas, which are the Indian forte. And of course, given that we only have perhaps less than 10 days to the results of the elections, I will stay out of the market right now. So in other words, it's not a matter of being defensive or offensive. It's a matter of seeing where the direction is going to go. Strictly speaking, in inverted commas, and I have to be very careful here, I'm not rooting for any of the candidates, because it's none of my business to tell the Indians how and where to vote. But let's say a clear, strong coalition government will be relatively good for business, to the extent that should the government decide to be pro or anti-business, whatever that is, at least it will have the majority in the Congress to be able to get on with whatever legislation needs to be. That will be a good, strong sign. And of course, on that particular base, then if inflation looks a little bit better, then I will definitely be going for procyclicals, because the next move, of course, will be for the RBI to cut interest rates. So wait for the elections, and then I will be cautiously procyclical, with a footnote on the famous infrastructure. But the infrastructure is totally dependent on government policy. It's not dependent on what the private sector in India may or may not do. You don't build airports, railway lines and highways on the basis of private incentives, so to speak.
Okay, Andrew, always good chatting with you. Appreciate you taking the time out and speaking with us on India and the globe.